More than anything else, it's debt that determines which companies will survive and which will go bankrupt in a crisis. During 1985, I was looking at two depressed stocks in technology, GCA and Applied Materials. Both manufactured electronic capital equipment machines to make computer chips. In late 1985, GCA stock fell from $20 to $12, and Applied Materials did even worse, falling from $16 to $8. The difference was that when GCA got into trouble, it had $114 million in debt, and almost all of it was bank debt. It had only $3 million in cash, and its principal asset was $73 million of inventories. But in electronic business, things change so fast that 1 year's $73 million inventory could be a $20 million inventory the next year. Who knows what they could really get for it in a fire sale? Applied Materials, on the other hand, had only $17 million in debt and $36 million in cash. When the electronic components business picked up, Applied Materials rebounded from $8 to $36, but GCA wasn't around to enjoy the revival. One company went kaput and was bought out at about 10 cents a share, while the other went up more than fourfold. The debt burden was the difference. It's the kind of debt that separates the winners from the losers in a crisis.